So welcome back. Let us now understand the bifurcation of the face value of shares. Suppose that a company issued 1 lakh equity shares at the face value of rupees 10 each, but as per the Companies Act and as per the SEBI guidelines, the company cannot collect the whole amount of money at one single installment from the shareholders or subscribers. The company had to break the total amount of face value into multiple installments, and now we are going to understand the bifurcation of the face value of shares into various parts. First of all, number A, application money. Application money is the token amount of money collected by the company from the general public who applied for the subscription of company share to the company share to book the issue of shares. So first of all, when a company issued shares in the market, then it collects only application money. So application money is a certain amount of token money which a purchaser or the subscriber has to pay for buying the shares or for buying or subscribing the shares of the company. For example, if a company allows 10,000 equity shares at the rate at the face value of rupees 10 each, and the application money is rupees 2, then the subscriber has to pay rupees 2 for purchasing shares from the market. Number 2, allotment money. And the remaining rupees 8 of the uncalled amount of shares are bifurcated into various parts or installments, so that the subscriber does not have to face any financial burden while paying that amount of shares. These are divided as follows. Number B, allotment money. Allotment money is the amount collected by the company from the subscriber during the time of the allotment of shares to them. Number C, call money. Call money is the remaining portion of the face value of shares that a company called and collected from the subscriber after allotment money. Call money can be called up in installments like first call, second call, final call, etc. Number D, it is not necessary that a company always issue share capital at par, that is at face value. Many times a company can issue share capital at a premium price, that is a price higher than its face value. Then the share premium will also be included into share premium, or securities premium will also be included into the various installment of shares. However, the Companies Act 2013 strictly prohibited the issue of shares at discount, that is at a price lower than the face value. So let us understand in simple terms the bifurcation of the face value of shares. Face value is the total paid up value of a shares. So when a company issues shares at market, then it determines the face value of each share. Suppose that the face value of each share is rupees 10, but since the company knows it will be a burden, financial burden on the subscriber or the purchaser of shares to pay the whole amount of money. So the company divided the whole amount of face value into several small parts or small installments, and these are as follows. First of all, the company collects application money. Whenever a company issues shares in the market, then for booking or purchasing their shares, the subscriber had to pay a little amount of token money called application money. This is called share application money. And after 1 month installment or 2 months installment or some few months of installment, the company collects some other portion of money which is known as allotment money, that is share allotment money from the subscriber or the purchaser or the purchasers of shares, and this amount of money is known as share allotment money. And again, after gap of few months, the company collects the remaining portion of the face value through call money. Again, it is up to the company whether they will collect the entire remaining amount of money through a single call, or they further divided the remaining money into different calls. In case the company collects the entire amount of remaining money from the subscriber, then it will be treated as the call money or the share call money. But it is up to the company to further divide that amount of call money into several small parts, and in that case it will be like this: first call money, share second call and money, share third and final call money. But sometimes whenever a profitable company issued shares in the market, then their shares have huge demand in the market. In that case, the company issued shares at a premium, that is at a price higher than the face value of the price. Suppose that if the face value of the shares of a company is rupees 10, and due to the huge demand, the company issued their shares at a price of rupees 20 per share. Then in that case, 20 minus 10, that is the remaining rupees 10 will be the securities premium. And however, previously the company can also, in case of those companies who does not have so much value for their shares, they can, or in case of new startup company, they are allowed to issue shares at a discounted price, that is a price lower than its face value, to attract the purchaser or the subscriber. But nowadays the Companies Act strictly prohibited the issue of shares at a discounted price. However, SEBI has provided some guidelines regarding the issue of share capital. So some important SEBI guidelines regarding issue of share capital are as follows. We always know that SEBI is the controller of the financial market of India, and it is a central government organization. So SEBI has issued certain important guidelines regarding the issue of share capitals. The full form of SEBI is Securities Exchange Board of India. So let us see what are these guidelines. Number 1, the application money should be at least 25% of the nominal value. That means whenever a company collects application money, then the company cannot determine the application money at its own will. According to the SEBI guidelines, the minimum application money should be at least 25% of the nominal value, that is the face value of shares. So if the face value of shares of a company is rupees 10 per share, then the application money should be at least 25% of 10, that is rupees 2.5. Number 2, the minimum gap between two installments should be 1 month. So it is another important rule. The company cannot collect the remaining installment of share capital money at its own will. According to the SEBI guidelines, the minimum gap between the two installments of collection of share money should be 1 month. So a company cannot, so after collecting the application money, a company cannot collect the share allotment money before 1 month. It can collect the share allotment money at least after 1 month. It may be 2 months or 3 months, but the minimum gap should be at least 1 month. And similar is the case for the collection of remaining call money, that is share first call money, share second call money, etc. The minimum time gap should be 1 month in all the case. Number 3, as per the Companies Act 1956, the minimum subscription of shares cannot be less than 90% of the issued amount. If the minimum subscription is not received, the company cannot allot shares to its applicants, and it shall immediately refund the entire application amount received from the applicants. That means that according to the Companies Act 1956, the minimum subscription of the shares of a company should not be less than 90% of its issued amount. Suppose that a company issued 1 lakh shares in the market, but the subscribers purchased 80,000 shares. So in that case, the subscription of shares will be 80% of the company's issued shares. So the company in that case cannot transfer that money into the share capital amount, and they have to refund all the money according to the company's guidelines to the subscribers. But if the subscriber purchased 90,000 shares out of rupees 1 lakh, then it matches the minimum subscription. So in that case, it matches the minimum subscription amount, that is 90% of the issued amount. And even if in that case, the company can transfer the application money to their share capital account. So always remember the fact that the minimum subscription amount should be at least 90% of the issued amount. If it is less than 90%, then the company has to refund all the money to the subscribers. securities premium. As we discussed earlier that sometimes a profitable company have huge demand of shares. So in that case, that company can issue shares at a price much higher than its face value. In that case, the extra amount of money over and above its face value of shares will be treated as securities premium account.